Well, thank you guys for joining us. We have people that flew in from all over the country, including on a red eye. So just shows how amazing Charlotte is, that we can attract this great talent. So our panel today, we're going to talk about financial inclusion, fintech for all, right? This is something near and dear to my heart. I'm a Mexican immigrant. I work on financial services. And it's something I think about and talk about probably to the chagrin of all of my friends ad nauseum. So, there's a saying that diversity is being invited to the party and inclusion is being asked to dance, right? I'm not quite going to ask you to dance, but I am going to ask you how you're getting the inclusion party started. So here's what I want to start with. So I want to, we can read all all are obviously amazing, and we can read your bios online. What I want to talk about first is if you can give us just a 1-minute sort of cocktail party introduction and tell us about your role in the financial inclusion movement. So more like if your cocktail party was about financial inclusion. Kareem, you want to start?
Yeah, hey everyone, my name's Kareem Salah. I am the Executive Vice President at a company called Zest Finance. Zest Finance helps lenders approve borrowers they previously declined using AI and machine learning techniques. And what we find is that if you're willing to apply better math and more data, that you can safely approve more borrowers and bring more people, expand access to credit in a manner that is safe and that your regulators can get comfortable with.
Hey everyone, my name is Chen. I came over from the CFPB, where Alex and I were colleagues, to the Federal Reserve Board about 1.5 years ago to help them think through fintech work. They've got a wide number of people that were already doing all kinds of interesting stuff in this space, but my goal was to try to help them think through their role as a safety and soundness regulator in terms of sort of what fintech is, why it should matter, and what we should be doing. I should say that in the spirit of being a consumer protector, as a disclaimer, everything I say here is in my personal capacity and does not reflect anything official statement of the board. But I look forward to the conversation.
Thank you. Good morning. I'm Puneet Modi, and I have no disclaimers to make here. I'm global client partner with Infosys. I work with some of our strategic accounts in financial services. And as a global service provider, we have a bird's eye view, front seat view of the technology's role in inclusion. And this is what I would love to share as part of this panel discussion. I'm also a proud Charlottean, have been here a long time. And given that Southeast US, Charlotte has higher rate of underbanked and unbanked population, I think this is a very relevant discussion for the group here. Thank you.
Hi, I'm Steve Landry, CEO with Meade. We're a global financial tech company out of Santa Monica. We are developing a network of global banks to offer a fixed set of services and product features specifically engineered to address the issue of underserved and millennial segments.
So you all really are some of the folks leading this movement, right? Leading the inclusion movement that sort of recognize that traditional finance might not be reaching all of the sort of factors of the credit spectrum and really the world. Can you talk about, just briefly, other than your company, what do you think is the most promising innovation in fintech that you think is going to really advance the ball on inclusion? Steve, do you want to start?
Well, I think for us, the biggest entry point was really the proliferation of mobile technology, right? Because that allowed constituents, customers who don't have access to brick and mortar to now have access through the means of mobile technology. Certainly biometrics is the second one I think that we're looking at as a means to help with the onboarding and origination and servicing of those customers. Those will probably be the two we hang our hat on.
And Puneet, you've done some work on biometrics and identity.
Absolutely, and I think so, if you look at biometric space, right, that's probably, I totally agree with Steve, right, that's one of the biggest enabler, especially when you go to the developing world where ID itself doesn't exist. I think it's probably one of the most important tool out there to create the identity which ultimately will drive inclusion. If I can add one more item, right, I think the whole API ecosystem, right, where we talk about embedded banking, platform banking, in essence, take the banking to the people who don't have access, right? So that is probably in my mind another key capability which is going to play a big role in financial inclusion.
And we'll get into that idea of sort of identity as inclusion later in the panel. But that, APIs are a key part of your business, right? Creating sort of the alternative data stores. Is there another sort of piece of that that you think is really advancing the ball?
I mean, look, I think that not to talk my own book, but I think that we are in the very early innings of machine learning and artificial intelligence eating financial services. I mean, I think to date, machine learning and artificial intelligence has had very little impact on financial services. You see it in high frequency and algorithmic trading, you see a little bit in fraud detection and marketing, but you don't really see it at the core of consumer lending, like who gets credit and who doesn't. So, from my perspective, it's the advance of AI in regulated high-stakes use cases, right? And it is the fact that computation is now infinite and free, and that there's an explosion of data available. And I think that's a very potent cocktail for our inclusion cocktail party.
Thank you for finally going with my theme. Kelvin, you see all of these folks, right, that are trying to really be bleeding edge in inclusion. What are you most excited about?
So Governor Brainerd wrote on this last fall, and we're really thinking a lot about sort of the building blocks in this space. So data aggregation is the sort of the industry by which all this data flows, and it allows for all kinds of interesting things like cash flow underwriting, or to do a true ability to pay calculation where before you really had to make estimates of that. So we're really thinking a lot about ways that data aggregation and other ways that bank data can be used by third parties to build new things, but also to do that in a responsible way, in a way that puts the consumer in the driver's seat and leaves them in control. I'd say certainly access to now by the minute cloud computing power and also open source AI tools are super important. And the thing I would also note is that it's allowing all kinds of innovations outside of just the credit space, right? Because I think our former colleague Corey Stone wrote an article recently in American Banker talking about how credit is one pillar of financial inclusion, but there are other tools you've got to think about, right? So you've got automated savings tools that are going to be coming out. You've got things like income smoothing tools. So there can hopefully lead to sort of a wide array of tools that can help consumers in the space.
And that issue of data aggregation, we have probably maybe half bankers, half tech in the room, and that's a really, they can be fighting words, right, for a lot of bankers who feel like they're being essentially forced to share data without a ton of, guardrails, at least set by regulators. And they worry, I think, that being forced to share that data is going to create a ton of risk for them, when really they have no control. These are not third parties to the bank, right? They're not sort of parties over whom they have any leverage. So, I mean, what would you say to that sort of, that dichotomy of?
No, I mean, it's a really tough issue. Again, sorry, in the government, you're safer when you're quoting other government people. So Governor Brainerd did a speech on this also. If you were to Google Federal Reserve and Pokemon Go, it should hopefully be the only hit that comes up. And what she talks about is, if you look at the iPhone ecosystem, right, we now all have smartphones other than BlackBerries because Apple opened up their systems, right? They open up what you can build with your GPS, what you can build with your camera, what you can build with the other sensors that are involved. And from that, they're getting an estimated $3 billion in revenue from Pokemon Go, right? Like something that they didn't have to invest anything in development costs or in advertising or the like. And so, with fintech, one thing that we often take for granted is almost every fintech app that we talk about is something that's built on a bank stack ultimately. Because if you want to do national lending, if you want to do payments, if you want to touch deposits, you got to hit a bank. And so that convergence, right, of moving the API ecosystem into the banking world was somewhat inevitable, if not advantageous for banks if it's done correctly. The problem with Pokemon Go is that when that was first rolled out, Niantic used the wrong APIs. And so they used an API that could allow you to rather than just identify that this is Kelvin, to say, instead they got an API that said, hey, here's Kelvin's emails and his contacts and his calendar invitations. And hey, if you want to write emails on behalf of Kelvin, you might be able to do that as well. And Niantic recovered, right? It was just a blip for them because there weren't bank regulators in that space. And we now have used Pokemon Go so that we've walked to Pluto and back. But in the banking space, that's a real problem. And so that's primarily where we're spending a lot of our time thinking, sort of what are the rules that should be in play there, right? If they're coming at and taking information without a bank's control, does that fall under the Bank Services Company Act? Where's the service?
And I think, so I want to sort of level set, what data are we even talking about, right? I think when we talk about alternative data, a lot of folks think that we're using sort of the face of the moon that was present when you applied and your zodiac sign and your shoe size to determine whether to give you a loan. In my experience with my clients, that's not really what's useful. Can we sort of level set about what are you all seeing as actually useful alternative data that is predictive, that might be the next level of of data that will become mainstream.
Happy to take that one. Yeah, so I mean, I think there's been a lot of hype about kind of the creepiness factor in data, and what we find actually is that financial institutions get plenty of lift just by using utterly banal data that they already have. So for example, we work with one of the largest credit card issuers in the world, and they were able to increase their approval rate by 10% with no corresponding increase in risk just by adding their consumer relationship management data to their underwriting process. So how many times did you call into the call center? When you did call into the call center, did you call to tell us you were what did you call to tell us? You called to tell us you were going to be late? Like that's a sign of a pretty responsible borrower. I mean, fundamentally, when you are underwriting someone for a loan, you're making an assessment of whether or not that person is responsible. And it turns out that there are indicia of responsibility everywhere. Do you regularly exceed the number of minutes in your cell phone plan? Or do you wait until after 10 p.m. when texting is free to send your messages? When you get your paycheck deposited in your account, you go straight to the racetrack? Or, so it turns out that like you can find indicia of responsibility in all of these utterly banal places if you care to look.
And one criticism of that type of data is that it's gameable, right? You can sort of look responsible. But I guess my answer to that has always been, that's great, right? Like if we can get people to act responsibly, even if it's just to get a loan, like maybe that's not such a bad thing. Steve, is there any data that you're sort of excited about, sources of data, types of data?
No, I think we're mostly focused on propensity type data, so things that will help us to lead consumers where they want to go rather than drive them where we want them to go. I think Jim alluded to it in this talk earlier this morning about helping them to help themselves by knowing what to anticipate their needs to be. And I think that's where we're at this point.
And go ahead.
The only other thing I'll add is, if you look at work which is happening overseas, especially if you look at two examples, UK and Singapore, right? So what those governments have done is they've created a sandbox environment where actually you can try out real life but controlled usage of data, which is actually facilitated by regulatory bodies, and really see what's the impact, how it's really, if it's affecting privacy, if it's affecting any kind of regulatory issues, if it's likely to show up. So that's the other way to approach it, right? One, you have these data points, and even if you worry that some of it may affect privacy issues, maybe there's a sandbox environment to work through it, right? So.
Right, and I think, to play devil's advocate, I think that is, I work with a lot of consumer groups, and there is a fear that being too predictive is going to force people into these boxes from birth, right? From high school, maybe, where, I am a Hispanic woman. Let's say that I apply for a mortgage when I'm 50. I think, do we want to know that I'm more likely to get diabetes and therefore I might not live to be 90, so they shouldn't give me a mortgage? I mean, I think, how do we respond to that? To saying, okay, predictive is good, it's inclusive, it reaches in to folks who might not have a FICO score. How do we then keep that from going too far and saying, you're never going to make it, 8-year-old, we know that based on all the alternative data we have on people who look like you, you're just not going to go anywhere, so I'm not going to give you a loan ever. And then you're definitely not going to go anywhere. So how do we sort of phase that challenge of being predictive but not too predictive, that we're sort of forcing people into these tranches? Calvin?
Kareem?
I'll let the regulator take that on.
So I can't answer that question, Alex, but let me answer a question that's kind of more in the. I'm gonna give myself a softball.
The question you want to be asked? Okay,
exactly.
I get it.
It's hard, and one of the things that we're spending a lot of our time thinking about is sort of what are sort of the ground rules that should come into play when you're using artificial intelligence and other sort of like high. More advanced analytics to do things like credit modeling, but also other things, right? Because it's, what are the rules, how predictive and sort of what should the constraints be when you're thinking about things like determining fraud, right? Because a lot of times when you're looking at your risk in making a loan, it's really often hard to tell whether you're looking at someone that's a bad credit risk or someone that's like a synthetic ID, right? And how do you parse that apart? And so, we have tried to, we're in the early stages of thinking through how we should be sort of setting sort of ground rules for AI usage. And we're trying to be very thoughtful about not being too invasive and being too prescriptive in how people should apply things. So, in certain spaces, in certain for instance, one question that often comes up in this space is, when you've got something that's making a crazily predictive prediction like that, and you can't see inside the box, right? Like, is that going to be a problem, and what should be, what should apply? And Vice Chairman Quarles spoke on this recently, and you're going to have, as he noted, you're going to have sort of situations where you are mandated by statute or mandated by policy to be clear about what you're doing, right? So if you have to give an adverse action notice, then you actually have to give an adverse action notice. But in other spaces, what he pointed out is that it may be advantageous to let the AI be the AI, right? So for instance, AI is open source. We're going to be running up against situations where banks are going to be having to use AI tools to catch AI tools that are trying to structure transactions, right? Or to try to file fraudulent applications. And in such case, if you were to shackle your AI, then you might be a step behind in going after them. And so, the way Vice Chairman Quarles put it is that in certain cases, maybe it's all risk weighted, right? But depending on the risk that's involved, in certain cases, it might be advantageous instead to let the AI be a black box, but to put a wrapper around it, right? To put a circuit breaker around it so it can do its work within its confines. And then you have like a human check or something else on the outside, say, is this reasonable, is this rational, right? So, one of the things we're doing is thinking about how that framework would fit into things like our traditional model risk management. Because, we don't want to be surprising the regulated institutions with new rules every time someone comes up with a new math equation, but to say, how does this actually change things? And the hope then is to give some guidance so that, I can't really speak to predicting, but for 8-year-olds, but to give some guidance about when you've got something that comes out of a black box that does seem a little surprising, what kind of controls should you have in place to think about that?
And Brian, go ahead.
So just two-finger intervention on that. I mean, I think the first is, right, look, I speak for loan underwriting, the existing system basically consumes 20 attributes about each applicant, and because it can only consume about 20 attributes about each applicant, those attributes have to reflect the majority of the population, and with all due respect, who's the majority of the population? It's mostly old white guys, right? So, like, the current system is locking minorities and women out. I think if you're able to look at more data, you can paint a much richer portrait and bring a lot more people in. Now, whether or not, will some people be disadvantaged by that? Yes, I think there are probably some people who are getting credit today that look like get good credits that actually are not good credits. I mean, folks in this room know that not all FICO 650s are created equal, I'm sure. But then, sort of as a corollary to that, I want to pick up on something Kelvin said, which is, but of course, like machine learning, artificial intelligence techniques have drawbacks. And a big one is this black box problem. And like, should you really be running your lending business off a black box model that you don't understand and can't explain to your regulators? I think the answer is clearly no, especially when you have obligations to monitor for fair lending, compliance and give adverse action. But increasingly, again, not to talk my own book, that is a problem that is being solved by folks like us and others.
And I think, so I like this idea of at least being able to explain, to understand what you are doing, even if you can't understand how the model works. At least being able to say to our regulators, here's generally how we're seeing.
I go further than that. I mean, you should understand the variables that your model is taking into account and to what extent when rendering those decisions. And you should be giving real adverse action notifications so that folks can actually change stuff and come back and try again to get a loan when they've been denied.
I'm going to, I guess, take the industry position, weirdly. The thing I would highlight, right, is that everything that we put out in terms of our guidance and our expectations for controls are risk-weighted. And so, Kareem's talking about in consumer lending where you have very specific requirements that are very clear statutory requirements about what's expected of you of your analytics. But AI tools can be used for a wide variety of things, for a wide variety of risks. And so the controls and the explanations and sort of the oversight that we'd expect of that would be consummate with the risks, right? So looking at your MRN guidance or our vendor risk management guidance, in other areas, the expected controls may actually be lighter.
So a lot of what I work on is third-party risk management for AI, right? And what's really hard is the traditional, 1997, 2007 guidance that we're all familiar with doesn't really apply well to models that are, first of all, very protected because their whole livelihood is on building hard models. But also also that they're meant to be changing every day, right? So we do model risk management, great. So if you test it today, you're probably safe today. And the model is going to continue to iterate on itself tomorrow and the next day, right? So how do we adapt? For example, Steve, what is Meade doing for sort of making sure that you have ongoing light into the models you're using?
Yeah, so the structure for Meade is that we sit above the banks and we rely on the bank's underlying infrastructure and risk profiles in systems to take place and to manage. So we're not guiding or directing that. What we're trying to do is facilitate it through open platforms and through giving them access to additional data.
And is this something that comes up from them? I mean, is this something you're hearing about?
It is. Our initial foray, because again, we were focused on underbanked and millennials, was not to get into the unsecured portion of it.
Okay.
So most of our product up front is highly collateralized, and so they're not worried about that up front. But now we're working with them to, after they've had early months on books and they have some performance data that they can analyze, to then go ahead and migrate them into unsecured lending to start to build that credit profile.
And so propensity data is, universally useful. How do you explain to folks who are using your platform what it is? I mean, obviously you're working with banks, but do the consumers understand what you're looking at, do you think?
So we took a different approach to this. We basically took a greenfield and said, look, banks have historically underperformed trying to tap into this market. They've not been able to determine how to profitably serve it, right? So we said, what's the problem with that? And we basically re-engineered the process from a consumer perspective to say, what are the tools, financial services, products, and features that consumers need, basically, to run their day-to-day lives? How do we develop that in a cost-effective means by eliminating as many points of friction and frustration that keep them out of traditional financial services industry, drive them back in, but protect them from the kind of nickel and dime approach that most commercial banks have, overdraft fees, transaction fees, and the rest of it. So by doing that, what we're able to do is give them transparent pricing, act as their advocate with the banks that are part of our network, and allow them to have access to that without the infrastructure cost that banks normally assess to them. We flip it around, and now we have to take the bank's position. Banks have to make profit off this. So how do we do that? We eliminate the same points of friction, servicing costs, origination costs that are a problem for them, and we eliminate their acquisition costs up front that allow them now to bring these customers on, cultivate them over the life cycle, and migrate them into more traditional products.
Alex, if I can add two dimensions, right, which are important. See, as over the years, people sort of understand how FICO score comes about, right? At least what you can do to be on good side of the equation. And as some of these, machine learning models are evolving, right, I think there has to be significant emphasis on education, right? And I use that word, in a slightly broader sense. You can go out and, teach this to kids, but you can also educate practically everybody in this room, right? That what that model will entail. So I think there's an effort needed to, educate people, get them up to speed, because this is not going away, right? Whatever we may wish, there is always going to be, Steve here who will figure out how to, use this optimally and, make it profitable, right? So I think we have to find some level of learning which needs to go out. Secondly, like how we maintain data today, I think there has to be an amount of effort, and we are starting to see a lot more of those demand come in terms of managing the model itself, right? So can I baseline model as of today, right? Can I baseline what has changed between today's and tomorrow's version? What was your data at the time of decision, right? So if we need to come back to it, how do you sort of really access this at a different time in future? Right? So.
And I think that gets hard when you're using 300 points of data or 8,000 points of data. I think we're going to move to a system. I think we're moving to a system where it's going to be very hard to tell you exactly why a loan was approved, which is sort of what a lot of what Kareem and his folks try to work on. To say it's not this data point, it's the relationship between this data point and this 5 other data points that sort of made the decision. And I think maybe it's a fiction, right? That consumers have a way to affect that. But what do we do with that, Kareem? What do we do with this weird sort of the relationship decision making, that it's not on one data point, but on sort of the interaction of several data points? How do we explain that to people? How do we make it meaningful?
Yeah, I mean, I'll give you an example of how two seemingly innocuous variables can interact in a really unfortunate way. So we have one of our clients is an auto lender. And one of the variables in the model they built using our platform was, it's a used car auto lender. And so one of the variables they use in their model is the mileage of the car. Kind of a sensible attribute, right? Like more mileage on the car, the higher risk, kind of intuitively makes sense. The other signal in their model was like, are you in state 47, state X? Okay, states are really big. There's no like fair lending concern or redlining concern there. So you go to compliance, and the compliance guy says, oh yeah, high mileage of the car seems like an appropriate variable. Do you live in state 47? Seems like an appropriate variable. Well, guess what? Taken together, those two variables, if you were to have a high mileage car and you live in state 47, it's a perfect proxy for black. Wow. Right? Wow. And so, yeah, like again, I think that's why this issue that you've touched on, which is model risk management, is super important, right? You got to be able to explain not only the provenance of this data and the kind of math you used, but the ways in which these variables interact, which frankly, existing mathematical, the logistic regression methods that are used today, like don't adequately do. And so from our perspective, you're absolutely right. Like machine learning models, like can learn the wrong things. And it's not a question of like, are machine learning models biased? Of course they're biased. By the way, logistic regression models are biased too. It's like, how are they biased and to what extent? And how do you make the model's decision-making transparent so that you can account for those biases, right? By either taking out those variables or making other adjustments.
And I think, so Kelvin, this is where you come in, right? It's sort of, what incentives are sort of regulators creating, or conversations are regulators having to say, here's some things that you need to be able to do, right? You need to, I mean, and you know, the Fed, I think, has done a great job of trying to send some signals. The Bureau has put out some, you know, opaque but guidance on what they think. You know, what do you think are sort of some basic principles that regulators are sort of concerned about when it comes to the use of this data?
Yeah, so I think for the consumer lending context, what I will say is that there's an article that one of my colleagues put out last October. It's in the Consumer Compliance Outlook. It's a woman named Carol Evans. So she actually leads basically any team that will sue you if you do something awry in this space. And she kind of lays out her thinking in her personal capacity, but the fact that she heads all these teams is really useful. And so she kind of put out a roadmap for the way that her teams think about UDAP risks and fair lending risks when they come to alternative data. And so I think that's a really like a useful tool and a useful point of engagement. Another thing, two other areas where we're really spending a lot of time are things we've touched on. One is vendor risk management, right? Because you know, per our earlier discussion about Pokemon, very rarely are these fintech firms going to be doing this without a bank partner. And so they have to understand what the bank partners are worried about for them to be successful. And bank partners have to understand what their responsibilities are in order for them to innovate. And so, you know, we've been spending a lot of time thinking about, you know, whether our vendor risk management needs to be looked at in a new light, given the new world that we're in. You know, where it fits and where it doesn't fit. And frankly, you know, we're open to feedback, and we'd love to hear from people about, you know, where we think we could be better. The last bucket would be MRM, which is what we've already talked about. And so that's, you know, I will note that the MRM guidance, at least our MRM guidance, as it stated, actually does contemplate your not knowing what takes place with proprietary vendor models. So that's something that's already built into it. Again, you've got to compensate with other controls. You have to make sure it's risk weighted. I do like Governor Vice Chairman Quarles' idea of sort of the circuit breaker, the wrapper. I was on a panel recently with Beth Knickerbocker, the innovation officer at the OCC, and she used the example of she has a friend that worked in a cheese factory in Wisconsin, and they had a robot that handled the cheese, and if the robot got too hot, it would like start flinging cheese everywhere. and so they put a box around the robot, right? So that's like literally, right, you're cabining the potential bad impacts of automation gone wrong, right? And so if you can put a box around your cheese robot when you're doing this kind of modeling, right, that is an avenue that we're interested in learning more about.
That's going to be a gross box. I feel like.
Yeah,
But this gets to something actually that we're working on, which is kind of the monitoring of these models when they're in production, right? I mean, so one of the questions that we get a lot is like, would your models have predicted the 2008 crisis? Right. First of all, anybody who tells you that their models would have predicted the 2008 crisis is full of BS. But more than that, our models would not have predicted the crisis, but what you start to see in the fall of '06 when you run the data is that it starts sending up flags to say that the input distributions have changed. Something in the world has changed. The kind of applicants that we're seeing, that the model is seeing now, are different than the kinds of applicants that it was trained on. Or, for example, on the flip side, hey, like the model has just started the output distributions have changed. Hey, the model has just started approving people that look considerably different from the folks they were approving before. Throw up an alert. So I think that this question of MRM and monitoring, I think, and explainability and accountability ultimately for these systems is like, we're headed for a big public debate over those issues.
That's right. So let's think about that. So if you had, I'm a lawyer, so I'm kind of a fan of having some idea, like I'm kind of a believer in the wise restraints that set you free kind of thing, right? But I know that's not a very popular thought. So if you could go to the White House today and bring your wish list for, regulatory action or inaction or change, what would be the top item on your list? Steve, what would you want?
I think at this point probably is transparency. I think that's the biggest thing. It parallels into the education comment you made, that in order for people to embrace the environment, the financial services environment, they need to have faith and confidence. And that transparency, I think, is the thing that's missing. We say we're transparent, but people typically are not.
Right.
And I would actually suggest that in sort of goes against, I think this is an area where some bit of regulatory support and intervention would be helpful, right? So it almost goes against the grain of saying deregulate everything. But I think just providing that foundation, and I think we have been involved in some bodies, again, I was mentioning that UK, Singapore example, where we have seen a lot of acceleration, right, in fintech's ability to serve the market and ability of banks and companies to include more people in the financial ecosystem greatly amplifies, if there is some bit of support and infrastructure to go with it.
I'll skip you, Calvin.
Thank you.
Yeah, I mean, from my perspective, I think it would be examination requirements for machine learning models, right? So when I go into financial institutions, it used to be when we started the business, we go into financial institutions and say, hey, you should really use machine learning for underwriting. And they'd be like, no, logistic regression works fine. Now we go into financial institutions, we're like, hey, you should use machine learning for underwriting. They're like, yeah, we totally get it. We're just afraid that Kelvin's going to write us up for it.
He does look pretty mean, I can see.
Yep.
Yeah. Well, so, yeah, I mean, I think the hardest, having been in the government, right, I came from the CFPB, as Calvin mentioned, it's really hard, right, to sort of, you have a lot of constituencies, you have a lot of folks who have to agree to one sentence in an exam manual. And so I think part of it, Calvin, is, having you here is great, getting regulators to listen to what the issues are, hear from companies that are trying to make a difference in this space and trying to sort of figure out, okay, how do we meet that? So when I shift a little bit from sort of all data out models to identity, which is one of my sort of pet ideas, is, we, in the States, we think a lot about sort of identity protection, data protection, right? But it sort of presumes that everybody has an identity or has sort of a financial identity. And we know that's not true, right? That's certainly not true in many developing countries. And for, a lot of millennials, immigrants, other folks who are not, deeply rooted in the financial system, the identity is weak, right? Their FICO score might not exist or might be very thin. And so, I want to sort of think about that concept of identity as inclusion. Puneet, I know you've done a lot of work in that space. Can you sort of lead us off and sort of what is the role of identity in creating more financial inclusion?
Right. So I mean, identity is the basis of financial inclusion, right? I think we had Kretpal a little bit earlier talk about, how they are trying to find opportunities to serve people who don't have, clear identity to leverage, right? But much before that, I think, Alex, this is also a space which has seen tremendous progress, right? This is a space where technology is and continues to play a powerful role. We touched upon biometrics a little bit, but just to put it in perspective, if I take example of India, in last 7 years, they have added 250 million people into banking system by creating a biometrics-based ID platform, right? Just it's almost size of the whole adult population in America, right? So just in a reference point, that's the kind of inclusion biometrics-based ID could bring. United Nations is driving a program called ID 2020, right, which is looking at identity for refugees. So most refugees end up with no papers, right? They don't have a passport, they don't have any other social security card. how do you identify them, right? How do you make sure services reach them? So they are leveraging biometrics plus blockchain, distributed ledger technology, to create identity, which is then one unchanged, but also accessible at different places. And then I think the most, another interesting example is Estonia. So if you don't know, Estonia is a company which was created when USSR split in 1991. It sits right next to Nordics, right? And Nordics are fairly well-developed countries, with great market. So to really differentiate themselves, they have gone all in on e-governance. So everybody has a cryptographic-based digital ID card, a mobile ID card, and almost every service is accessible through that one card, right? So again, great inclusion tool, right? Because now there's nobody left behind, right? Everybody has access to all the facilities which are offered in the market. And then I think we have touched upon this back home here in US, using alternate model, alternate data. I think Kareem talked about really using simple additional data points to enable access to wider population. So there is definitely tremendous progress, but this is also a space, where inclusion is going to, be further driven by strengthening of ID, or creating new capabilities or new technologies to create the ID itself, right?
And I think it sort of shifts the conversation, right? Because I think we've all heard about the right to be forgotten, right, with the GDPR, but I think there's sort of a primary right to be known, right, to even sort of have access to the system that will know you. And we see that I think with a lot of new entrants to the banking system is that the issue is that they're not known, right? They're sort of a wild card. How does Meade help work with that? I mean, how do you help folks develop an identity?
So we rely obviously on the region we're working in, and those were great success stories. I think, we've had some experiences where the opposite of that, where we could originate a customer relationship completely remotely and do everything remotely. But because of the regulatory environment in that country, we were forced to drive customers into brick and mortar branches, which in some cases were 50 miles away. Right? It made no sense, but the country just hadn't evolved to that state yet, whether they were ready to adopt biometrics and other forms of remote ID. So what we do is we work with our bank partners in those countries to address the regulatory agencies in those countries and try to move it forward. But we rely heavily on whatever the regional acceptance of ID is, and then incorporate that into the biometric solutions we use.
Very good. So just rapid fire here. Before we get to questions, I do want to take a couple questions. So let's say we hacked inclusion. We fixed it. This panel right here, we got together afterwards and we just solved it. What does a solved inclusion problem in the financial sector look like? In 2 sentences or less. Okay. You can have
fair and transparent credit for everybody, where fair means more than 20 attributes.
The CFPB did some really interesting research on financial health, and the big thing for them is just making sure that they determine that financial health is really a subjective measure, right? Making sure that you feel comfortable with your finances. And if we can get to a point where people feel comfortable so that they can take risks, right, and do interesting things and be innovators, I think that would be a great thing.
And what does it mean to be comfortable, do you think?
Well, I mean, that's the thing that was super interesting from their work, is it really is subjective, right? They didn't try to apply a standard measurement as to what comfort is. It's almost like the pain scale, right?
Yeah.
But getting to a point where people are able to start thinking about things like the future, and they're planning and taking risks and doing things with their career that they without having to sort of be stressed out about the day-to-days. That would be a great point.
I like the idea of a financial inclusion pain scale where red is, you only get credit if your dad had a 780, and green is everybody gets credit, so we want to be somewhere in the yellows, I think. What do you think, Puneet?
I mean, my view of financial inclusion success would be if everybody has access to basic savings, credit, and I think insurance, right? So in some ways, that to Kevin's point, right? I think that probably provides that green button for most people, right? There is a level of foundation in place just in case anything bad happens, right? And that insurance could be for a business, for a person, but I think those are the 3 things in my mind which probably makes successful inclusion.
Okay.
Pretty basic, universally available financial services at a fair price, right?
I think that's right. And I think, part of what we think a lot about is what does it mean to be truly universally available, right? Is it, some of the new solutions that have come up are targeting a particular market, right? They're getting better credit and more credit to folks who were going to get credit anyway. Maybe not today, but in 3 years, right? So how do we get to that sort of second level? And I think rolling back to the first question in terms of what's the most exciting innovation. Can we just talk briefly about what is the biggest gap? Like, what do you wish people were working on today? Companies, not regulators, but really, if you had a brilliant guy coming out of MIT that said, I'm going to start an app, I want to hack financial inclusion, what would you ask him to work on?
Actually, can I take that as a...
Yeah.
So, I mean, part of that, I think, is that we have to think about things, one, from an interdisciplinary basis, but then two, also looking at specific populations, right? So for financial inclusion, so Pew, for instance, found that 60% of Americans are going to have shocks of like a median hit about $2,000, 30% of within a year. 30% of Americans are going to get that hit twice. Whereas we found that the average American family has got less than 50% of American families don't have access to $400 in the case of an emergency. Right, so like credit will help you with that for your first hit, maybe, probably not for your second or third hit, right? So we've got to think about other things like healthcare, affordable housing. Like financial inclusion is unfortunately a very interdisciplinary problem, and an app can be a part of that, right? But unfortunately, there's not going to be a killer app in this space, right? There's no single even regulator that sits over financial inclusion that has the authorities that are relevant. The other thing that I'd also say is that we have to still look at things from a very, I think we're starting to recognize that we have to look at things from a very population-specific perspective too, though, right? So we had a situation where Census put out this paper that seemed originally pretty non-controversial, saying educational attainment's important. If you go to college, it's going to have a net positive impact on your lifetime earnings and your lifetime savings. But then St. Louis Fed put out a 3-page paper that I think is probably one of the more important things that pieces of research that the Feds put out this year, where they said, well, if you look at it by population, that doesn't hold up for all populations. And for Blacks and Latinos, going to college actually sets you back from a lifetime earnings perspective. And that is a huge public policy outcome. That's a huge message. That's a huge sort of question about how we think about financial inclusion. And so all this is to say is that we've got to sort of think interdisciplinary in terms of how we're going to address these issues, but then also think about what individual populations are we leaving behind.
All right, so for all the folks that are pitching today, if this doesn't work out, here's the next one. You can say Kelvin gave you the idea. So I do want to take a couple questions before we head off to lunch. Over there?
Now you're able to underwrite some of these populations. At what point do you then take into account risk-based pricing and potentially, delving right into predatory lending? Because if you think about 04 leading into 08, started to see some of that, and I think Stephen, you mentioned the aspect of fair pricing for credit.
I certainly don't know.
I mean, I sell software tools to banks, so I'm not sure I'm the right person to answer that question. But you're absolutely right. I think that banks in cooperation with their regulators and also just good sense of ethics are going to have to grapple with exactly that problem. I think the issue is that some large number of people will be revealed not to be creditworthy. And or you got to figure out how to structure a product that's appropriate for those people and give them a bridge back to, prime status.
One more question? Over here? Anyone? Oh, right here. I can't see you. The lights are on.
Alex.
I hear you.
Just yell.
We're talking about we use consumer data. Talk a little bit about the example of I'm 80 years old or I'm 50 and I have diabetes in my family. Those types of scenarios. Clearly, there are regulations forbidding that type of stuff, and there's we've got a lot of different rules around that. So where do we draw the line? Where do we look at the risk and say yes or no without being ageist or using health data that's clearly you're not necessarily able to use?
I mean, I think that goes to Kareem's point, right? Is
It's a public policy discussion, right? I mean,
Yeah.
issue really. I mean, this is.
Yeah, Kelvin, what should we?
Well, I mean, that's ultimately what Congress grappled with ECOA, right?
Yeah.
And then as implemented by Reg B, and then and then sort of thinking through teasing that stuff out. But that as I understand it, is those are the four corners of what you should be dealing with, and then from there on, it's the conversation that we're having now.
And I think that's what's hard, is that people basically say, look, we thought about this. These are the things we decided to not allow. Pretty much everything else is fair game. I think that's
So I
shifting.
can't say that, but
I
I say with my
think
hands
that's
in
a
my lap,
perception, that like it's up to, to Congress to decide where the line is drawn. But I think, several of you have mentioned it, companies like all of us in this panel are going to have to grapple with that yourselves and say, I know what's allowed, but what am I actually going to be doing, right? And I think I don't know, do you all have that conversation, Steve? It's sort of, I know what the law is, but here's where I'm going to stop short because this is where I'm comfortable.
Well, frequently, and again, we rely on the banks to
Yeah,
control their
right.
own risk appetite, but we're trying to advocate for the consumer at the same point. So we have to make sure that they're doing it in the right manner, and it's a daily challenge.
Yeah. Well, so it's not hacked yet. So again, for all of you who are innovators, let's innovate in this space. Thank you guys so much.
Thank you.